Hi, everyone. I'm Rick Bensignor. Today is Tuesday, June 6th, and welcome to this week's In the Know Trader show. What we're going to talk about, the lesson of the week: gather facts from the media, not their opinion. Gathering facts is going to help you become a smarter trader. The latter, as in listening to their opinion, will likely help you lose a fair amount of money in the markets. That's what we're going to talk about. Before we get to that, let me talk to you about what we have in the Know Trader. We have a weekly ETF Tactical Trader report, comes out Thursday evenings, gives a very broad and specific background into everything that affects the U.S. equity markets. So we're talking about the fixed income market. So let's say the U.S. 10-year, credit spreads, the U.S. dollar, the gold market, the oil market. We then do a deep dive into the S&P for both my near-term and medium-term support, resistance levels, and how to play the market. I then give you a brand new ETF trading idea each week, and then finish it off by going through each and every open position that we still have on from prior recommendations until we close out those trades. That's the weekly ETF Tactical Trader report. Again, comes out Thursdays. Sign up for it at intheknowtrader.com. The second written report we have is called the 7-11 Monthly Spider Sector Report. The goal of this report is to beat the return of the S&P 500 over time by being in no more than 7 of the 11 Spider macro sector ETFs each month. Here's how we've done with that report. Take a look at the middle of the page. As of May 31st, in 2022, we outperformed by just over 6%. In May, we outperformed by 28 bips to now get us up by 43 basis points over the Spider's return this year. And historically, since I started writing this report in August of 2020, that's 34 months ago, this report has outperformed the Spider's return by 13.58 percentage points. That means you would have an extra $13,582 to be specific on a $100,000 investment. So if you were abiding by the recommendations that I do monthly in this report, and you started with a $100,000 account, you would have an extra $13,582 in your account as compared to just sitting in Spiders over the same period. That is a huge difference. I've also accomplished this return while having or taking less risk than the S&P has. So I have a lower standard deviation to this portfolio with higher returns. The golden ticket of Wall Street is doing just that: less risk, higher returns. If you've got money in Spiders sitting in your long-term investments, you should strongly consider subscribing to the 7-11 report if you're interested in doing better than the market does. In 10 minutes a month, you reallocate to 7 of the 11 Spider sector ETFs. What am I talking about? XLK, XLP, XLE, energy, right? There are 11 sectors to the market. There's a Spider ETF to each one of those. In their proper weightings, if you had all 11, you would get the same return as the S&P, or the same thing as being in the Spider, the SPY. We have, or better said, I have outperformed that handily over the 34-month history. So you're costing yourself money by simply having dollars sitting in the Spider ETF as compared to spending 10 minutes a month to follow what we've done based on the performance we've had so far. You can subscribe to my In the Know Trader YouTube channel at youtube.com/InTheKnowTrader. Follow me on Twitter at InTheKnowTrader. That's the 2 written reports. I also do individual coaching sessions, which is taking up more and more of my week now. I have many, many people coming to me to help them become better traders, better technicians, have better approach to the market, to better profit over time. So if you know that you need some help and that what you're doing isn't working for you and you're not getting the type of returns that you want, sign up for coaching sessions. You can do as little as a single hour. We have a package of 3 at a nicely discounted price, and some people sign up right away for multiple packages of the 3. So you can find all that information at inthenotrader.com. Next is I'm going to be making a big announcement in coming days for a brand new In the Know Trader subscription service that many of you have asked me for quite some time to create. So details are coming shortly. If you're already on my distribution list, if you've previously subscribed, I will announce this through an email and social media. But just know that in coming days, we are making a big announcement here and getting you a brand new subscription service. The lesson this week was about gathering facts from the press and not their opinions. So right now, in the last 24 hours, you're seeing that the press is reporting that the S&P is in or just at the point of becoming a bull market. So this was, I just did this a few minutes ago. I inserted this chart into this slide deck. So the S&P is at, where is that, 4281 or so, something like that. And now they're saying, the press is saying that we're in a bull market. We've just become in the bull market, or about to become in a bull market. Now, what's that based on? We'll get to that in a second. Notice that from the October low, we've certainly seen higher highs and higher lows. So that's the definition, at least, of an uptrend, not necessarily a bull market, but an uptrend. We're no longer seeing lower highs and lower lows. So we're no longer in a downtrending market. But the press has decided that we're in or on the cusp of a bull market. So let me show you a couple of articles that have come out in the last 24 hours or so. So here's the first article, and it's entitled "The 20% Up Rule: Bull Market versus Bear Rally." And look how this article starts off. Market watchers have warned that the rally in stocks, which was briefly proclaimed a bull market Monday after rising 20% above its low from October, is da-da-da-da-da. So right away, this whole idea of a 20% move constitutes a new bull market off of a low or a new bear market off of a high. Silly. Even the fact that it was briefly proclaimed a bull market on Monday. By whom? Besides the press, who called this a bull market? Who that matters called this a bull market? And anyone on Wall Street who's using this is just following along on something that is absolutely unproven and trying to simply pack into a simple definition what a bull or bear market is. Absolutely silly. This one is a New York Times article from yesterday saying, is the bear market over? It depends. And they're showing the same chart I've just shown you, but with farther back history, going to the COVID decline here on the left, and then the massive recovery, a sell-off of approximately 20% in the S&P last year, and then the recovery since October. And first saying now, we're at the cusp of a bull market. Here are a couple of quotes that I've pulled out. Now, this is just a piece of the article, but I've pulled out some quotes from here. We're not in a horrible spot, says so-and-so at a major Wall Street firms. There are recession risks for sure, but we have to see how those materialize over several months and into next year. So technically, this is a bull market. So this is a person who's already decided we're in a bull market. I'm going to skip the second one for a second. We'll come back to it. Here's a strategist from Wells Fargo saying, I think the 20% rule has been an easy one for folks to follow. What 20% rule is he talking about? Well, there's a lot of people on Wall Street who have come to the decision that if you decline 20% from a high point in the market, when you hit the 20% decline level, you're now in a bear market. And last year saw a bear market, but not necessarily because it fell 20%. In fact, the S&P fell 19.5%. But the market traded like a bear market the entire year until, and even through the October low, until at some point after you decide it's not a bear market. But I think everybody would agree that last year was a bear market, but if you looked at this definition of 20%, then the S&P didn't actually trade in a bear market because it only got down 19.5% by year's end, but was more than that at one point. So what this gentleman is saying is that I think the 20% rule has been easy to follow for folks because if you wait for a 20% move, you can then, according to him and other people who follow, who ascribe to this, that you're now in a bear market. Or if you bounce 20% or more from a market low, you're in a bull market. And that's, of course, where we're dealing with now, as the S&P is basically 20% off of that October low. So he's saying that I think it's an easy rule to follow. It's an easy rule if it actually means anything. And that is not at all proven by data. Here's another person saying, everyone has been so defensive. First of all, when you see somebody quoted and they start and use the word everyone, it's already BS because everyone has not been so defensive. The polls do not prove that. The polls that matter certainly don't prove that. And he goes on to say, there's a lot of cash on the sidelines. According to State Street Global, who put out a report last month, and few firms know better than State Street Global about cash holdings. Cash holdings in portfolio managers' portfolios is nothing more and nothing less than typical over historical measures. So saying there is a lot of cash on the sidelines implies that there's a lot more than normal, and therefore a lot of people have missed the rally. But again, that is not what the data shows. So two things about what this person, Andy Brenner of National Line Security, says to me is incorrect. First off, everyone has not been so defensive. And secondly, there's not a lot of cash on the sidelines compared to history. So these are quotes, they're not facts. What's the fact? If the S&P rallies X percent from a particular point, that's a fact. If you get opinions from either the press, their own opinions, or people who they quote, understand they are nothing more than opinions. And their opinions are not generally going to help you a heck of a lot, because a lot of their opinions are not based on anything that's actual fact. I want to go back to this second box from the top, because this, I think, is an excellent quote from Peter Bookvar. He says, if a stock goes from $10 to $5, right, so it's lost 50%, and then from $5, it rallies to $6, which is a 20% move off of the low. It's not a new bull market. So, and I agree with Peter very much. This 20% rule is just this kind of out there thing that the street has slowly adapted to, and more importantly than the street is the press has adopted to this with no factual basis and no historical precedence for any of that to mean anything. So I love the fact that Peter says if stock goes from 10 to 5 and then from 5 to 6, it's not a new bull market. He's spot on. That 20% rally means nothing when you've just fallen 50%. That's what I think you need to understand and pay attention to. And relying on the press for their opinions is not a good way to likely increase your profits. Gather data that's actual facts and make your decisions off of the facts, not off of the opinions. You'll do much better in the long run. That's today's In the Know Trader Report. I hope you found it helpful. I'm Rick Bensignor. See you again soon.